all here with us. We have our CEO, Josh Baer, joining us for a few words about Capital Factory.
Howdy. My name is Joshua Baer, and I'm the founder and CEO of Capital Factory. Capital Factory is the center of gravity for entrepreneurs in Texas, the #1 state for startups in the U.S. Thousands of entrepreneurs, programmers, and designers gather day and night, in person and online, for meetups, classes, and co-working. With boots on the ground in Austin, Dallas, and Houston, we meet the best entrepreneurs in Texas and introduce them to their first investors, employees, mentors, and customers. Capital Factory has invested in more than 300 Texas startups over the past decade. Whether physically in person or virtually online, Capital Factory is buzzing with energy and activity every day. Start with all the geekiest events on meetup.com and sprinkle in out-of-town guests, book signings, hackathons, innovation conferences, and pitch events. We're talking about thousands of participants every month. Most of the events are free, open to the public, and streamed over the internet. Capital Factory is all about community. Everyone's here to meet other people who can help them on their journey or to help others find their way. We kick off every morning with a text-based Ask Me Anything session with a mentor or investor in our Slack channel. Anyone in our community can ask questions in real time, and everyone else can see the answers. These are some of the most active investors and the most successful entrepreneurs in Texas. Those same mentors and investors do regular office hours where they volunteer a few hours a month. It's easy for any of our community members to find people with specific interests or expertise and to book a 30-minute meeting with them. With hundreds of mentors and investors in the network, there are dozens of meetings happening every day. Our co-working space provides desks, offices, conference rooms, classrooms, a podcast room, a video conferencing booths, and more. But the most important spot is the kitchen, because that's where everybody comes together. That's the real reason everyone's here, to meet each other. And every day at Capital Factory is demo day. Maybe it's the local angel investor network or a venture capitalist from out of town. Maybe it's one of the Fortune 500 scouts looking for new tech or a state or federal government official. It's delegations from other countries, school kids, army generals, and celebrities. We've helped entrepreneurs get in front of Tim Cook, the CEO of Apple, Satya Nadella, the CEO of Microsoft, Sundar Pichai, the CEO of Google, and even President Obama. How do we know who to put in front of the president? Well, first, they go through an intensive interview and assessment process where they're vetted by our staff and our mentor network. We categorize them by industry and technology and score them based on traction and potential. Then they have to work their way up to the top. On the way, they'll often meet with members of our Innovation Council of Fortune 500 scouts looking for startups with technology that can give the big companies a competitive advantage. They're hanging out in the kitchen of the co-working space and in our Slack channels online. They partner with startups to go after big government contracts with the Army Futures Command, Air Force Ventures, and the Texas Military Department. The money is flowing. In the past year, 30 startups in our community received more than $60 million in non-dilutive funding through government programs. Capital Factory is also the official Google Tech Hub for Texas. Google plugs us into a global network of other entrepreneurial communities and creates unique opportunities to help our startups attract investors, increase diversities, and access Google services. All of this activity creates exclusive deal flow and data for our investment fund. Our goal is to invest in the best deals in Texas, no matter who leads them. Over the past 10 years, we've secured $110 million in pro rata, super pro rata, and follow-on rights in more than 600 companies. We watch them all interact with our mentors, investors, Innovation Council, and each other, so we know which ones to invest in. Some of our most successful companies include Aceable, Coder, Data.World, Icon, Sensei, Storable, and WP Engine. Are you ready to quit your job and become an entrepreneur? Do you know someone who is? That's who I want to meet. And those are the kind of people who I can introduce you to. You can message me directly on Twitter at Joshua Baer or email me at josh@quityourjob.com.
Thank you, Josh. We appreciate that overview of Capital Factory. Well, today I will be joined by Tina Dai. Tina is the principal at Silverton Partners, In her role, she invests in and supports founders as they build companies that are going to shape the future of our world, which is pretty cool. Prior to joining Silverton, she worked at First Round Capital, a leading seed stage venture firm in San Francisco. And she previously held product management and strategy roles at Intuit and was previously a consultant at McKinsey Company. Tina also earned her business honors and finance degrees from McCombs School of Business at UT Austin and is a lifelong Texas Longhorns supporter. And with that, I'd like to bring Tina to the virtual stage.
Hello there, how are you?
Hi, Tina. Thanks for joining us today.
Thanks for having me.
Wonderful. So you have an extremely impressive career thus far, from consulting at top firms like EY and McKinsey to becoming a product manager at Intuit, and then to jumping into VC at one of the best firms in Silicon Valley, First Round Capital. Can you just share, a brief background of your career and what led you to become a principal at Silverton Partners?
Sure. I would say overall, it came down to a lifestyle decision. So I grew up in Dallas, right North Dallas, in a suburb called Flower Mound. So I've always had pretty close ties to Texas. My significant other, his family is from Sugar Land, and ultimately venture capital is a very long-term role. And so when we thought about where we would want to raise a family, we wanted to do it closer to home. And so that's why I landed back here in Austin. But I'm also happy to talk through some of my backgrounds. And honestly, I think when I first left college at UT, I wasn't so thoughtful about exactly what I wanted to do. It felt like a decision between consulting or banking, which I ultimately picked consulting. Coming out of consulting, I would say, while the vast majority of my McKinsey projects were not in tech, I realized really quickly that everything was converging towards tech. And so I wanted to kind of get my foot in the door at a larger tech company. Making the switch from consulting to product management isn't a really natural one. And so I first started at Intuit in their strategy group. While I was there, my last project was around creating the next upmarket QuickBooks product. And so after that strategy project, I stayed on to launch QuickBooks Online Advanced. I think over time, product management felt more and more myopic to me. And so I wanted this broader focus on what is all out there in the tech industry, and venture felt like a natural role. And I had a good mentor at that time who had started his own fund and had shown me the ropes of what venture looked like. And so through my experience working with him and then getting advice from others who had been in my position of making the product to VC switch, I joined First Round Capital, and I worked with one of my best managers I've ever had there and learned so much from him. And now I'm here at Silverton.
Amazing. Well, I hear a lot of people say that, product managers at a company is kind of like an entrepreneur of, one of the products. And so in some ways it looks like you're kind of moving to the opposite side of the table now, of from a founder perspective to investor. But really congratulations on joining Silverton Partners as a principal. That's, very exciting. And Austin is very lucky to have you. And I really love seeing, badass women taking these leadership roles at VC firms. We need more women in, partner level roles really at firms. But, Silverton is one of the most respected VC funds in Texas. How do you guys think about differentiating from other great firms in Texas, like a Live Oak or perhaps the Next Coast?
Yep. So I would say that as far as our investment philosophy, we try to invest where we add the most value. And so I would also say both Next Coast and Live Oak are amazing firms, and a lot of the investing philosophies are similar. I would say that the way that we would differentiate ourselves is there's a wide range of great deals out there, and we know that we can invest in every good deal. And so ultimately, it's all about value creation for all of these firms. And so we all invest where we add the most value. And for Silverton, that looks like high growth companies in consumer products to enterprise software. We have a pretty strong focus here in Texas. And so 2/3 of our portfolio are here in Texas. A third is geographically distributed, but we view ourselves as a broker of services for our companies. And what that means is whether they're looking for customers, whether they're looking for advisors, board members, et cetera, we want to feel like we're best positioned to make those introductions for them. And the companies that we do best with are companies that have capital efficiency. And so part of what Silverton does really well is we exit a large majority of our companies in our portfolio. And so that means ultimately we favor capital efficient companies that really understand how to put a dollar forward to earn a multiple of that dollar back.
Okay, got you. Very good. I mean, I know Capital Factory, follows onto a lot of deals at Silverton's, and we really enjoy, co-investing with you all. But that's great to hear. I know for a lot of people that are joining in today, they're really curious to, hear more about Silverton's investment thesis and whatnot. And so that's great to hear. One thing that I'm really excited to talk to you about is VC economics. And this isn't something that we've actually talked about before on an Intro to Fundraising AMA. So really, really excited to hear your perspective on this. But, many founders don't understand the economics behind VC firms and why they function the way they do. Sometimes it really doesn't even have to do with anything about the company. Maybe it's where the fund is at in their life cycle. And so for first-time founders in the audience, do you mind giving a very quick crash course on how an early stage venture fund like Silverton works?
Sure. And I'll do my best here. It's not a super complicated formula, I would say, but there are some nuances to it. And I love level setting on the VC economics because sometimes I think there's this idea that VC funds are only looking for unicorns and all these things, which is true for some funds. And there's a strict rationale behind that. And so the rationale is really, say a VC fund is raising money, and VC funds are more or less just another business. And the whole business model is, can I take a dollar from my investors and call those investors LPs, and then return them, say, 5 times their money back over time. And so for a fund like Silverton, we aim to return about 5x of what a total fund is. And so say we raise $100 million in 8 to 10 years, we're expected to return $500 million to that fund. And so that fund usually lasts for 20 companies or so. And so we're distributing $100 million amongst 20 companies, but we, depending on the VC fund, this is where the math works a little bit differently. And so for a fund like First Round, if First Round has a portfolio of 20 companies, they would want, say, 1 or 2 unicorns in order to return the fund. Whereas Silverton, let's say we exit more than half of the fund. And so ultimately at the exit point, we're owning something like 10 to 15% of a business because we get diluted over time. And if we assume that over half or whatever that loss ratio is for the other VC funds of those startups gets written down to 0, then the actual burden of the companies that are exiting is somewhere in the range of, say, like 300 million, 500 million, or $1 billion plus, depending on how many companies end up getting written down to 0. And so that's the thing I think most founders don't intuitively understand about VCs. It's that we're a business like any other founder. And ultimately, depending on the loss ratio, we're looking for a certain exit for the startups we believe could succeed. And that's what imposes a certain, I would say, valuation expectation for that company.
Absolutely. And I mean, if you're raising $100 million fund to return that $500 million, it's not easy. I mean, you have to be really picky about the companies that you're investing in and, really have that faith that, or hope, luck, whatever it might be, that they'll exit, for a multiple. But for those in the audience that are not familiar with unicorns, a unicorn is a company that's valued at over $1 billion. This term was coined, a few years ago. And Tina, I'm really curious, why do VCs want and or even need a unicorn in their portfolio? We always talk about like the unicorn or the golden egg of the portfolio. Do you mind speaking more to that?
Yeah. So kind of going back to also the last question, I would say most VC funds have that strategy of let's find a couple unicorns for our portfolio. And the reason is because for the vast majority of VCs, the number of startups they write down to zero is like over 90% or something like that. And so one unicorn, if you're owning 10% at exit, is $100 million in this scenario. And so that $100 million is theoretically also supposed to cover the losses of all the other companies that we're invested in. And so that's why VCs with a higher loss ratio will more so go for unicorns, because that valuation expectation for the companies that they exit will need to return the entirety of the fund. And so Silverton has a slightly different model because our loss ratios are a little bit less. We're probably exiting more than half of our portfolio, and we're generally very comfortable exiting companies at 100 million to 500 million. And because we have a higher amount of exits, the TAM or valuation expectations on those companies go down. And so as a strategy, we don't necessarily need to find unicorns in order to return the money to our fund.
Got you. It makes it a little bit easier on the founders, I suppose. But really, I mean, founders can choose to finance their businesses in, a variety of ways. We see some founders bootstrapping, some of them doing debt financing from, like a Silicon Valley bank, and some of them actually raising venture funding. And I know there's, everyone has their preferred method of, financing their business, but why should founders actually take venture funding, and why should they not take venture funding? Really, like, what companies are most suitable to raise VC dollars?
Yep. It's such an interesting question, because I think there's this I don't want to say stereotype, but a concept that the only funding out there for startups is venture funding. And like you said, there's a ton of other different forms of funding. I think the biggest thing in terms of taking venture funding that you have to recognize is you ultimately need to say that I am a company that strives to make, say, $100 million in revenue or more a year. And the reason for that, again, goes back to the venture economics of the venture investor needs to potentially exit or sell their shares in your company at one point at that really high valuation. And so unless you're aiming for, 100 million plus in revenue, it's really difficult for a VC investor to feel like their goals are aligned with yours. I would also say that is ultimately just a decision that the founder has to make for themselves, right? Which is, there are very much a ton of businesses out there that can operate without having to grow at that expectation or get to that $100 million revenue. In some ways, you have to make a decision on, is my goal to capture such a large part of that market, or is my business meant to just self-fund myself for the remainder of my life, which is a very different decision. And I know that was kind of a long-winded answer, but on the plus side of taking venture funding, I would say that VC funds really help scale businesses and provide entrepreneurs with that mentorship and support, and being able to connect you with other founders who have gone through some similar phases of scale, and being able to provide you the relevant advice you need in terms of how do you raise additional capital, how do you raise debt, how do you think about all these other things that you probably haven't done before. And so VCs are there for companies in terms of having a perspective on the industry, on the other companies that are doing something similar, and providing that really relevant advice.
For sure. That's fantastic advice. And I really appreciate the really comprehensive answer there. I'm sure a lot of founders will come back to this and to hear your words of wisdom. But I know you hear a ton of pitches every year, probably thousands. And after a while, I know a lot of pitches start to sound the same. Personally, I can't take more than, between 5 to 10 pitch meetings a day, or else all the companies start to, blend together. So I'm curious, what has been one of the most memorable pitches you've heard to date? And no need to name the company, but really just describe the components of the entrepreneur's presentation that stuck out most to you.
This one's a really hard one. It is true. We do hear a ton of pitches.
Yeah.
During COVID, there's just so much. There's so much burnout from Zoom. One of my most memorable pitches. So I would say the best pitches to me are when a founder really understands and demonstrates clarity of thought around all the different questions that are thrown to them. That happens surprisingly not the majority of the time, but I would say the most memorable pitch I've seen has been a product demo around kind of a deep tech space. And the product demo is effectively, there's this company that was doing AI generated content. And their whole concept was, let me create this low-code, no-code platform where if you as a creator just start typing different things like Sally is wearing jeans, she's walking down the street, it's autumn, the AI generates that that scene for you. And so that was a really cool pitch, just because it was something I've never seen before, and I never envisioned a world like that before either, which is a really cool thing when founders share that with you.
That's incredible. I know it's really nice to see demos and, seeing them come to life. And, since the pandemic hit, we've really switched to this virtual first world where a lot of these first founder investor meetings are taking place over Zoom or, even other video conferencing platforms. And I don't know about you, but prior to the pandemic, I held the majority of my meetings with founders in person. And in my opinion, it was a lot easier to have these genuine interactions and, as you were saying, experience the products and the demos that were going on. Do you have any best practices or tips for founders that are taking these first fundraising meetings in the virtual first environment? And especially for those ones that do have really cool product demos that, when experienced in real life, just create a whole different effect with the meeting.
So I do agree with you that getting conviction on the founding team is such a large component of the investment decision. And I think the thing to understand is when an investor writes a check, they're also saying, not only am I giving you this money, I'm also giving you probably 5 to 8 years of working with you. And that working relationship is probably longer than most marriages. That's the risk that VCs are trying to underwrite in terms of the founding team, right? So a lot of investors are still getting used to underwriting the risk of only getting to know a founder remotely. And so in some ways, I think it forces investors to lean more heavily into their local networks to source deals right now. the thing to expect, I think, in this environment, at least for Silverton, since we are typically lead investors, so we'll write the majority of a check, we'll take a board seat and work really actively with value creation on the company. Not needing the founder has been a bit of a challenge for us. And what that translates to is just a longer period of time of getting to know the founder, tracking their progress, and seeing how they've responded to feedback, how traction has picked up. And so just to answer your question, I think the expectation might be, at least for lead investors that you have never met in person, that the process just takes a bit longer. And in some cases, we are now starting to, we'll take a walk or something with the founder because we're still trying to get comfortable with underwriting that risk.
Absolutely. Yeah. And I know you mentioned, so like the team is really big for you all. And there's kind of that debate in the early stages, what's most important, the team, the market, the products. For you, how do you kind of think about, these three elements? And are there other elements that are really important for you when looking at an early deal?
Yeah. I would say there's pretty consistently three things I look for. And the three things is, what is the unique insight or the vision that the product is built off of? And then I ask myself, number two, is this something I really believe in? And if I do believe in it, what's the corresponding market for that really narrow vision or specific definition that product serves? And then if that market is big enough, then I ask myself, is this the right team to capture part of this market? And is this the right timing for this team to go do it? And so those three components are pretty consistently how I make that investment decision. I think it probably for me falls in that order. If I don't believe in the vision, then it doesn't matter to me how big the market is. If I don't think the market is big enough, then I have to believe at least somehow they can pivot into a different market or expand to a different market, but it needs to be a big enough market to support that revenue that we were talking about earlier. And then if it's if the vision and the market all make sense, then I ask myself, is this the right team? And so all three of those things for me really, really matter. And I don't know if it matters in a particular order.
Okay. No, I love how you outlined that, all components that I've heard before in the past, but I really like how you phrase that.
Thank you.
And kind of in the order that you think about it. It's great insight. Well, I want to focus a little bit on Texas. So we recently moved to Austin from Silicon Valley. We've been seeing, a migration of founders, investors alike moving to Texas, in particular Austin. And so, I'm curious from your perspective, what drove you to relocate to Texas, and why are you bullish on Austin? For all the people that are from Austin in the audience, I'm sure they're really excited to hear your answer.
Yeah, so I came back because my roots are here in Texas, but also because I am so excited about the possibility of Texas as a growing ecosystem. Things have really transformed since I've left, and for a number of reasons, right? Texas is a very business-friendly place. And especially now, I think something like a third of the jobs here are in tech. And so Texas as a hub is starting to really, really pick up in terms of having the right components of a system to be able to support an innovation hub. And the thing that brings me back is I do feel like I want to play a role in potentially elevating and accelerating the Texas ecosystem. And I think one thing that is really helpful to Texas right now is because with COVID and with comfort around remote work and a distributed environment, it's accelerating flow of founders here from the coasts. And that matters longer term, right? Because people are now starting to reevaluate the higher cost of operating a company in the Bay or New York. It's way lower cost here. The talent is starting to pick up. And then more and more venture funds are popping up here as well.
Yeah.
And so I'm excited to participate in that and hopefully help this become the next, San Francisco, New York, top tier.
Yeah. Absolutely. I mean, I moved here, about a year and a half ago for many of the same reasons. And it's funny because I was based in, New York and had no intention of leaving. And actually, one of my girlfriends works at Silicon Valley Bank and does the debt financing for startups. And she's like, we're seeing so much activity down in Austin. You should really take a look at it. And, I did a little bit of research, but I was like, oh, that's cool. I'll still stay in New York. And then actually my dad sent me an article from the Wall Street Journal about Austin and what's going on here. And finally I was like, okay, I'll get on the plane. I'll go down to Austin and see what's going on. And, was so pleasantly surprised by all the, corporates that are headquartered here or even have, their second headquarters here. All the VC firms, great feeder institutions as well. Really just, fantastic, ecosystem and infrastructure to, launch and be the next tech hub. But, really, you have a great perspective on the differences and the similarities between Austin and Silicon Valley, now that you've lived in both. What's one common misconception that Texas entrepreneurs have about Silicon Valley?
Yeah, I think of all the founders I've ever talked to, there's this misconception that it's really, really easy to raise money. And in some cases, it's probably true that you can raise money based on one idea, and you can do that in both San Francisco and in Austin. But every person I've ever advised, it's taken a long time to do fundraising, especially as a first-time founder. And so that would probably be the misconception that stands out to me. It's a numbers game when it comes to fundraising. You're going to get a lot of no's, and you just have to continue to push forward and adapt.
Absolutely. Yeah. And we see, a lot of founders flock to San Francisco and they're like, it's a lot of money. This will be so much easier to fundraise here. But, at the end of the day, there are quite a few similarities there. I completely agree on that. And kind of going off that, question, what is one common misconception that Silicon Valley investors have about tech companies?
Yeah. This one's hard because Silicon Valley, at least, so I would say the bulk of my friends in venture are still in the Bay Area or in New York. And I feel like everyone's trying to get more deal flow and a better pulse here on the Texas deals. And so I was almost going to say maybe they don't believe that Texas companies or startups here are likely to be category creators or unicorns. But I think that's starting to be more and more untrue, especially as other founders continue moving their businesses here. And just for all the founders out there, I'm constantly having people asking me what are all the Texas companies I should be speaking to. So there's a lot more focus on Texas as an ecosystem. I even have friends who actively cover Texas as part of their markets. And so I think all things are pretty good so far here.
Yeah, maybe next I'll have to reword the question to, what makes them excited about, Texas entrepreneurs. That's fantastic to hear. And, hopefully we'll be seeing, some more investors coming down to, scout out the companies that are, being built here in Texas. Switching the conversation a little bit to diversity. This is something that's really near and dear to my heart. And in our previous conversations, you've mentioned, diversity and inclusion is extremely important to you as well. In my role, I focus on minority and female founders for our portfolio. I'm curious, could you just share a few goals that you have for your new role and how you want to make an impact on diversity in Austin?
Yeah. So my biggest goal in my role, aside from I do want to invest in more diverse companies.
Yeah.
Is I want to help more women become angel investors. And the reason I say that is because I think angel investing is traditionally a pretty mysterious thing. And the barrier to angel investing is really just education on what that process looks like. And I think if I am able to expand the number of angel investors, that has two downstream effects that I'm pretty passionate about. One is you have more female investors, for instance, who could have a portfolio and a track record on their judgment and picking for startups. And that ultimately would mean you have a stronger candidate pool for additional female partners, either here in Austin or anywhere else as for institutional funds. And the second piece is angel investing, and just investing in general is a very networked game. It's
all about who you know, not what you know, right?
Yeah, it's. I mean, most of it, especially the piece around confidence on the founding team, all has to do with signals that are coming from your network. And because of the nature of the flow of information in venture, I think if I'm able to get more females angel investing, it would be really helpful in activating their networks of more diverse founders. And so you'll get more capital that gets funded or that goes to funding diverse founders. And there's a couple efforts I'm working on there. So one, I am still in an angel group in the Bay Area, but I'm also a founding member here for the Beam Angel Network with Women in Austin. And
so excited that that launched, by the way. Oh, I'm very excited to see the impacts of it in Austin. Sending it to a lot of female founders to apply for. Do you want to just share a little bit more about Beam Angel Network?
Sure.
For it, would love to hear more.
Sure. I mean, the whole concept is around angel investors investing in female-founded companies. And one aspect to Beam is going to be around educating more angel investors, specifically female angel investors. And the other piece is around coaching founders through the pitching process. And so if you're a female founder, I would love to see you just Google maybe like Beam Angel Network and apply. We'd love to have a more hands-on approach to coaching our first cohort of female founders through the pitching process and potentially angel invest in you.
Oh, fantastic. I mean, I would definitely apply if I had a business. Pretty awesome. And going off of that, that's a great resource for females in Austin. And I know it's a very recent one, but actually Texas just ranked as the #1 state for female entrepreneurs, which was a stat that I was really excited to hear. Why do you think this is? And what support or resources in particular have you found that are most helpful for female entrepreneurs in Texas?
I would
say being one of those.
Yeah, well, Beam would be one of those. I think the ranking came about because the general business opportunity here in Texas is amazing for entrepreneurs overall. But there is, I think, a quarter of all businesses in Texas are owned by females, which is higher than national average. I think one thing that's really fun to know, and I'm very proud of this stat, is a third of Silverton's portfolio, at least for the last fund, are with female co-founders, which compared to the national average is phenomenal. Exactly. It's 2% or something for national average. And so I don't know exactly why or what the exact resources are that are most helpful. But the things that come to mind are, Women in Austin. There's a huge entrepreneurial hub at UT. Kendra Scott just gave back to UT for the entrepreneurship program. And so I think there's a lot of things that are popping up, and I don't know how to prioritize which ones are the most helpful.
Yeah, no, I mean, there's a lot of great resources here, and, ones that may be not particularly targeted just for females, but also, minorities in general, like at, Div Inc., for example. But, we are seeing so many awesome female-founded companies come out of Austin, like Julia Cheek with Everlywell, Kendra Scott with Kendra Scott. Yeah, and Tahini with Outdoor Voices. There's just a lot of great companies that are coming out of Austin, and so it's a great stat for the state to have, and especially for other females located in other states that are looking to relocate here. Well, we're about to open it up to questions from the audience. Selfishly, I love asking all my questions and learning from you. But if you have questions for Tina, make sure to put them in the chat window on the right-hand side of the screen. But Tina, before we open up to questions from the audience, what is one piece of advice that you'd like founders looking into to take away from this talk?
Yeah, I think, when you make the decision to go into entrepreneurship, you're already saying that I am a very, disciplined individual that's going to work my ass off to make this thing work. And I find oftentimes a lot of founders, we take that pass to mean it's a forever no. Mm-hmm. And I just want you all to remember that the no is flexible. Just keep coming back with updates, keep coming back with progress. The no is just like a momentary thing. It doesn't really detract from the reason why you started the business or anything about your business. It is just, it doesn't fit our venture business model for now. And so, I can think of a handful of companies where we've engaged for multiple rounds for 3 years before we invested, like the Helper Bees. We knew Char at the Helper Bees since the very beginning. We said no to him for every single round until his Series A. And so it's never a no forever. So just remember that.
Persistence. Well, a no is not a no forever. Probably, the first way to get a yes. Well, fantastic. Thank you so much for, answering all these questions. We have a few more from the audience that are really great. The first question we have is from Scott Schneider, and he asks, does an investable company have to be a category creator or a potential unicorn to attract the attention of an investor?
So the answer to that is no. But it does depend on the strategy of the fund. And I think the easiest way for you to figure that out could be just on some of the investment philosophy pages. If you look at something like First Round or Andreessen or most actual like West Coast funds, their whole strategy is to have category creators and to get, unicorns in order to return their fund. Whereas if you look at, for instance, Silverton's page and the number of exits, I think you can tell based on the number of exits that, or the size of the exits, that we're just very comfortable exiting at $300 million valuation, $100 million valuation. And so we will always look at businesses that could exit at the hundreds of millions versus unicorns.
Great. Well, before we move on to the next question, I just want to let you know some of the comments said they just applied to the Beam Angel Network and said it was a fantastic process. So love to hear good feedback. Okay, great. We're actually going to go to another question from Scott. Let's see. He says, is there interest in a portfolio company that has gained traction in the U.S. government, DoD, and some traction in the enterprise market and simply wants to accelerate everything?
So yes, I think this is my philosophy on companies that sell mostly to government. I think the thing you have to prove is that you are able to take that same product with little customization and gain traction in the enterprise market. So I think what you're doing based on your question is the right thing. It is not, like a company is definitely investable if they sell to the government. A company that only sells to the government and has a very customized solution for the government, which they potentially have to rebuild in order to sell to the enterprise market, is less interesting. So that's my general philosophy on that particular segment.
Fantastic. Okay, we have a question from Darius Stills. He asks, what resources would you recommend for distribution to aspiring angel investors? Might be a harder one.
Yeah, this one's a harder one. I don't have any links at the top of my mind, but I can share something with Jill that I've previously put together, and maybe that could get distributed for anyone who's interested.
Absolutely. Darius, just drop your email in the chat and we can send it on to you. Okay, great. And we actually have another question from Darius, which is one that I really, really like. He asked, what are some socially aware ways to stay in touch with the VC after hearing no?
Yes. So I think the easiest way, and I always ask for this, is to get added onto investor updates. I think it's a really hard ask for time from the VC if you've already gotten a no without showing that you've already proven otherwise the reason you got the no, if that makes sense. And so I watch investor letters. I read pretty much every single one of them. And if there's traction or things that would change my mind around my original conclusion, then I'll reach back out and schedule additional time. And so I think the most socially aware way is to one, add people to the investor letter, and two, if you're raising, just reach back out with a note saying, here's my updated deck if you're interested in taking a look for this round.
Very good. Yes, that's the way that we always say is the best way to stay in touch. And ask to catch up, go grab coffee or something. Investors are humans too. The next question we have is, what are the similarities and differences in raising capital for a company and raising capital for a fund?
Oh, yeah. So I would say that, the similarities are we still pitch to new investors. The difference is our measure of success is how much we return to a fund or how much our companies get marked up by follow-on rounds. And so for us, we have a pretty tangible metric that we report back to the LPs, which is how much return, even if it's not been realized, have we been delivering on a fund-by-fund basis. And the way that LPs work, which are traditionally just institutions like colleges, endowments, and things like that, is they allocate a percentage of their investment dollars to venture. And so once you're kind of in the door, you just continue getting that money back for the next fund if you're doing well. And so in some ways, for a fund like Silverton that's been around since 2006, on its sixth fund, has been returning in the top 10% of VCs consistently, it's much less of a selling process than I think for a founder. Every time there's a new founder or new company, you have to go out and convince the investor of that same investment criteria of like, this is my new vision, this is my new product, and this is how I plan to capture part of the market. And so I think what I'm trying to say is the burden of us raising capital is lower over time with scale and proven track record of success. Whereas for a founder, if you're starting a new company, you might have to restart the pitch process again, but you can leverage the relationships you already built.
Yeah, and hopefully those past successes as well. Okay, the next question we have is from Mir. She asks, how is Silverton looking at direct-to-consumer brands like a Billy in your portfolio in a post-COVID world as e-com as a percentage of all commerce has grown and continues to grow?
I would say that we're generally opportunistic as a company or as a venture fund, and our investing philosophy has not shifted that much because of COVID. And so we will do CPG, we will do consumer and enterprise. We're always just consistently solving for one thing, which is to find and fund the deals that have the highest probability of delivering returns to our LPs. And so when we look at D2C brands, We just look at I would say the consumer behavior based in the data and benchmark it to some of what has been best in class. And so if it is best in class, we would be interested. But we're not doing portfolio allocation, for instance, to say that D2C is going to be a higher portfolio percent, if that makes sense.
Great. Our next question is, what do you prepare before even attempting a fundraise? What should founders be thinking about prior to making pitch decks, starting meetings, etc.?
I think the pitch decks and meetings and all of that is really secondary. You have to be thinking about the customer that you're building the product for. I sometimes see when someone has an idea, they don't always go out there and validate that idea with just customer interviews and things like that. I think there's really very much like low tech ways you can validate certain things without having to build out a product or raise money to build out an MVP. Some of that could just be a ton of customer interviews, but you can do things like build a wait list, start creating like a Facebook group, and just seeing how much traction you can get that way in terms of engaging the type of customer you're trying to sell to, before you even start building the product. Just validate that the solution that you're trying to offer is a real thing that people want.
Absolutely. Our next question is, how much should you ask for in funding, and how do you present your product or service as enticing for funding?
How much to ask? Yeah, I think the short answer is you have to ask for something like 12 to 18 months runway. The real answer is you should be asking for, I think a function of this is, what do you think you could feasibly get, right? The way to think about funding is, at least the way I think about giving away funds is, compared to all these other opportunities out there, is $1 of me giving it to this one founder gonna learn more and return more than me giving it to this other founder? And so it's a really hard question, because I think as a founder, you have to solve for enough runway, which is usually 12 to 18 months. As an investor, you should be telling them, at least you should be telling the investor what you're learning per dollar. Like, what is it that you're learning on a per dollar basis that's going to incrementally like shift this business from whatever stage you are now to something that grows at such an attractive inflection point. And so I think the way to present it is, for instance, if it were a e-com business, and you could show that for every marketing dollar spent, your CAC to LTV ratio is just amazing. And so it's an easily scalable thing that once you pour in marketing dollars, your customers don't churn, and you're making X amount more for the business. And so I think that's the way to think about presenting it to an investor.
Great. And we have one last question. It says, let me find it. When presenting to angel investors, what is the criteria that they're evaluating your company on? In particular, if it's pre-product or pre-revenue?
Yeah. This goes back to kind of the other question around how do you raise money? So angel investors have a totally different investment criteria than institutional investors. And the reason is that they are their own sole LP. And so their investment criteria could just be whatever it is that they decide. And so I would say that angel investors generally want to make a similar return as a institutional investor, But you also get people who are really comfortable investing in more lifestyle businesses like restaurants and things like that. And so their criteria for how much they get returned, how long it takes to get it returned really shifts. And so when you're asking angel investor for funds, it might make sense to just figure out what their investment philosophy is and what their investment criteria is, in order to figure out some of the nuances of how you pitch to them. Because I do think I've met a lot of angel investors who can elevate the concept of social impact as part of their investment criteria, which I think is super important. And so I don't know if that really answered the question. But
no, that's great. I mean, angel investors, as you're saying, they're reporting to themselves, so they get to decide on that criteria. So for really each one, it varies quite a bit. Well, Tina, thank you so very much for taking the time out of your day to join us. I know everyone in the audience was very excited to have you today, and welcome to Austin. Hopefully we'll be seeing more of you. But I appreciate your time today.
Thank you for having me, and thank you all for listening. I hope that was helpful.
For sure. Well, for the rest of you that are looking to attend more Capital Factory events, you can just go to capitalfactory.com/events. We host these AMAs a few times a month, and would love to see you at the next one. Have a great day, everyone. Bye-bye.
Thank you.